everyone, it's Spencer here, and before we jump into today's episode, I wanted to just highlight a couple of things that are going on with Link Whisper. Link Whisper is a new WordPress plugin that I launched a few months ago, actually at the end of July of 2019, and over that period of time, we've received a lot of really positive feedback. People are enjoying the features that allow them to build internal links much faster, much easier. As you're writing a blog post, there's link suggestions that are automatically created, and it's easy as checking a few boxes to add those internal links. So it saves you a ton of time. Perhaps an even bigger feature is that it allows you to add inbound internal links to a post that you've just written. So if you have a post that doesn't have any links pointing to it, you can very quickly get suggestions and add 5 or 10 internal links pointing to that particular post. But one feature that we just came out with is the ability to do a keyword search for those inbound internal links. So if you wrote an article on Canva review, for example, which I did for nichepursuits.com just recently, I could do a keyword search for the term Canva, and Link Whisper will pull up all of the places that I've mentioned Canva, all the articles that mention the word Canva on Niche Pursuits, and then as easy as just checking a box, I can add an internal link to that Canva review article from a relevant, keyword-rich internal link from another post, saving me tons of time that I might have had to do to Google which articles on my site mention the keyword, going in and editing, etc. Overall, I just wanted to tell you that I'm really excited about the progress we've made on Link Whisper. I have tons of new feature ideas that I plan on coming out with, but it's been very well received, and I hope that you'll consider checking it out and saving yourself some time if you're into that sort of thing, building internal links on your website. And if you are, you can go check it out at linkwhisper.com. Again, that's linkwhisper.com. Thanks for listening in, and we'll jump into today's episode. Hey everyone, welcome back to another episode of the Niche Pursuits podcast. I am your one and only host, Spencer Hawes from nichepursuits.com. And today I'm really excited to have a guest on the podcast. His name is Ryan Kulp from microacquisitions.com or forkequity.com, or one of his products is Fomo.com, and he's got lots more. So what are we talking about today? Well, we're talking about micro PE, or micro private equity, micro acquisitions. And Ryan, over the last 3.5 years or so, since 2016, has made 10 plus acquisitions in the the software space. His first acquisition was Fomo.com. It's now Fomo.com. I'll let you hear the story of that just a little bit. Transitioned a Shopify app that gives notifications on Shopify stores when buyers check out and buy something. It's a social proof app that shows when people are buying and can increase conversions. And he's taken that from making around $10,000 a month in monthly recurring revenue to over $100,000 a month in monthly recurring revenue. And he shares a little bit of how he did that. But overall, we talk about the bigger picture of all of the acquisitions, the business model behind that, how and why he's acquiring so many businesses, and how he does it through sometimes creative financing, not always. Sometimes it's all cash offers, but other times it's creative financing, so he doesn't need to put as much cash down up front. And so beyond just talking about his acquisitions and what has worked well to grow those, he talks about his own company, how he structured that in terms of employees, what's working well, how much time he has to put into these acquisitions, and so much more. I find it a really motivational and inspirational podcast episode myself. Talking to Ryan, he's obviously a very smart individual. He's been very successful at what he's done. But what is really interesting is that before 2016, before his first acquisition of Fomo.com, he was just an employee somewhere else. It's not like he's been running and growing businesses on his own for a very long time. So in a matter of 3 years, he's built a portfolio with a annual recurring revenue of over $1.5 million, which is quite significant. So I hope that you find it inspirational, motivational as well. And if you want to follow along with Ryan, you can do so over at microacquisitions.com. With that, it's time for the interview. Hey, Ryan, welcome to the Niche Pursuits podcast.
Thanks for having me, Spencer.
Yeah, it is great to connect. Great to have you on the podcast. I was introduced to you by John Gillum over at Authority Website Income. And it kind of seems like you just came out of the woodwork. We had never crossed paths before, but you've kind of been building things for a long time, right?
Yes. And I think there's actually a lot of me's that are about to come out of the woodwork, because for a while, the concept of owning a handful of businesses, I think, was sort of limited either to larger private equity shops, so millions, tens of millions, billions in asset value, or niche content websites that obviously you're very familiar with. The concept of running multiple software products was kind of like a breaking the laws of physics, like it's a magic trick, right? Because people are struggling to run one software company. How could you possibly have the audacity to think you can work on multiple? Whereas content seemed a little more scalable. But now what we're seeing are people with a portfolio of apps. And we're able to, I think, do this because software no longer means go big or go home. You don't have to invent the spreadsheet anymore. You don't have to build marketplaces. You can build single player, small utility, people call them micro SaaS tools. Now suddenly software looks a lot more attractive. It looks a lot more like a niche content site, and you can scale and own multiple copies of them. So yeah, what I've been up to the last few years is working primarily on Fomo.com, but that was an acquisition. So my palate was wet in 2016 when we bought a tool called Notify, turned it into Fomo. And ever since then, we've bought around 10 other small apps, from Fomo competitors to other Shopify apps. We've sold a Shopify app. We've bought an e-commerce store. We've bought a niche content site that talks about e-commerce stores. And we've really been trying to build this ecosystem. And then finally, about a year ago, we put a bow on all of this by forming a vehicle called Fork Equity that now is the parent entity to all of those assets. So that's kind of me in a nutshell the last few years, and why I think our paths are converging, and why there are a lot more of me's converging with the content folks.
Yeah, I agree. It's an interesting perspective, an interesting development in sort of, I don't want to call it the startup world, because I don't view these as startups in the terms of the TechCrunch or the raising venture capital, or the, if you don't grow by some multiple every year, you're a failure or considered a failure, right? We're talking about small, profitable businesses that are cash flow positive, right? That you don't have to have a home run. These can be base hits and make all of the owners, a lot of money. And then if you have a home run, which we can talk about FOMO, but is doing very well, even better, right?
That's right. And I think a key ingredient to that, though, is, like you said, to have a base hit and not a home run is not so much about a philosophical preference. I think all of us want a home run, right? If FOMO could become a unicorn, why wouldn't I go for that? But FOMO is not designed to be a unicorn, and FOMO isn't endeavoring to be a unicorn. And again, the key ingredient is that we're bootstrapped. So if I raised capital, I would have to, as they say, swing for the fences. I would have to. And in fact, if I raised capital for FOMO, for example, it's possible that some of my investors would be not happy right now with our performance. Not because it's a bad company, but because our year-over-year growth rate or our month-over-month compounded growth rate wouldn't be, an all-star in their portfolio. Profit isn't really that interesting when you're venture funded, because the real cash infusion comes at the time of exit, not from optimizing margins. And so I think on the front end, you have to decide as an entrepreneur, do I want to swing for the fences? If so, I raise capital. If I raise capital, I can't grow a steady, linear, cash flow positive company. That's not really interesting to my stakeholders. So it's a paradigm shift. Whereas if you want to have a portfolio of projects that hedge and diversify for you, and you do want to look at margins on a regular basis and not just the top line, well, you kind of need to make different decisions. And so, for example, I also couldn't possibly work on more than one project if I raise venture capital at
Right.
FOMO. That would be, a huge no-no. I wouldn't even be able to go on vacation. Now, I don't go on vacation anyway, but you understand what I'm saying is that, an investor is not interested in hearing about your other cute side projects.
Hmm.
Whereas when you go the bootstrap route, you have that ability. However, I will mention though that it's a big decision because I think they say that the first million is the hardest, and that's the entrepreneur speak. But it applies in everything. The first $1 million your company makes is the hardest, even if none of that is profit. The first $100,000 is harder than the second $100,000. So I think a part of going down the bootstrap route where you can build a portfolio and you can focus on margins and you don't have to work on only one thing for 7 to 10 years and hope that you sell it to a strategic buyer. What that really entails is that you are willing to go through kind of like the obstacle is the way, right? You're willing to go through that
Hmm.
early stage where most people get, I don't want to use all these fake war phrases like slaughtered, but where most people get bummed out or knocked out and they kind of think to themselves, I can't do it, or no one can do it, or therefore it can't be done. And then they get back in the hedonic treadmill of let's raise venture capital and try to sell to a strategic. But yeah, I've found that once you do these things once, you kind of don't believe that you can do something until you do it once. And
Hmm.
then you go, I kind of figured that out. And you just develop an addiction for repeating that process over and over again.
Absolutely. So I'm curious your background a little bit. I mean, what led you to this sort of decision to go into micro acquisitions, this micro PE? What were you doing before? I mean, were you always were you in either the finance world, right, the private equity world, or were you a software developer? And if not, how did you ever come to buying software companies?
The way I got into this in one word is serendipity, to be honest, and luck. I was in a kind of quasi finance, but still startup entrepreneur tech role. I was working at a venture capital fund actually in San Francisco in 2015 to 2016. And early 2016, I recently moved to San Francisco, so I was switching over all of my credit cards to online subscriptions and services. I had to change my address from my former New York apartment. And one of those credit card alerts I got that said, hey, log in or you're going to lose your subscription was for a beef jerky subscription box that I subscribed to. And so I logged in to update my payment method, my new zip code, and boom, I got hit with this notification that, someone just bought, a subscription to beef jerky 5 minutes ago, something like that. And as a marketer, I thought, what the heck is this sorcery, that I'm seeing right now? And kind of inspected the HTML on the page and inferred it was a tool called Notify. So what I immediately did actually was, acquisition was not in my mind. I wasn't even familiar with the concept other than, this is something startups want. They want to be acquired. But I reached out to the founder and said, hey, I work at a VC fund. Are you interested in raising capital? And he actually happened to live in San Francisco. And I said, oh, I'm in San Francisco. Maybe we can meet, talk about it. And he said, no, I'm actually not interested. But I am willing to sell it if you know anyone. And I thought, oh, okay, bummer. Right. So like if you're in VC and you're trying to get a deal done and the person says not only that they don't want to raise, but they're actually disinterested in the product, they want to divest, you usually kind of like run and you
Hmm.
don't bother them. But in passing, I happened to mention it to my buddy Justin Mayers. Maybe we were like at dinner or something a night or two later, and he said, oh, maybe we should buy it. Again, the thought hadn't occurred to me. This was not an independent thought. I certainly give him credit for this. I said, okay. And long story short, fewer than 30 days later, we owned the company, him and I. So that's how I got into it. In fact, I stayed working full time at the VC fund. And then after quitting the VC fund in the summer of 2016, I joined another company full time. I joined one of our portfolio companies. FOMO remained this side project that I worked on nights and weekends. I worked on with Justin. We would order Sprig, rest in peace. We'd order Sprig
Uh-huh.
food delivery at our co-working space in Soma. And I didn't go full time on FOMO until I think we were near 30,000 MRR. I kept it as a part-time side project.
That's fascinating. So you really kind of stumbled into it, serendipity, as you explained, which is really interesting. So let's talk about the FOMO deal just a little bit more. How did you pay for it? Did you just buy it outright, 100% cash, or what was the deal structure there?
Sure. So I'll talk about all of the structure and all of that. We have a sort of understanding with our original seller to not talk exact numbers, but I think everyone can get the spirit of the deal with fewer pieces of information. So essentially, the seller, of course, who doesn't want cash up front, right? So at the very beginning, Justin and I took this approach that, hey, we don't know if we can buy it, but it's like a cool business and it should be bought and it's viable to be acquired. So worst case, we could try to very quickly broker a sale with someone else we know who has more money than us. So we weren't even sure if we would buy it. We just thought we could be a part of this transaction because we were both living in San Francisco. We both know rich people. We both know people who believe in us, who could fund it and that kind of thing. Of course, I'm sitting there at a fund that was interested. Actually, my fund was interested in acquiring the tool and having me kind of run it as an operator. So we had access to capital, right? But we were not independently, loaded, right, to buy and get this deal done. But again, more serendipity. We began talking with the founder, and we made an offer. The first kink, not really kink, but it reduced the cash requirement. Is the founder was really interested in our vision for the product. He knew we were both marketers. I think he looked into us, and he wanted to retain some equity. So right there, regardless of what the valuation is, let's just use simple numbers. Let's say the valuation was $1 million. If he wants to keep 10%, well, now we're only on the line for 900,000, right? Or less, depending on how you want to do your discounting. So that helped. The next wrinkle came when I think shortly after we had sort of found a ballpark valuation, we made an all cash offer. And our perception was twofold. First, he won't accept this just because things never work out, right? You make an offer, as you get older, you realize like things never work out. And the second half of this offer was that we would figure out how to pay him. So we were very confident that if he accepted, we would go to our rich buddies and get the deal done. So we made the offer and he accepted, but on a condition. So not only he wanted the retained equity, which reduced the cash position requirement, but he said that it was better for his situation if he got paid over time. And when that happened, it was like, So now we have another attribute that we can use to our advantage. So once you're paying someone over time, suddenly having all the cash up front doesn't matter. In fact, it's kind of like a waste, because if, let's say, we got a loan for the full valuation, to then have all of it up front and not need to use it means we're like paying interest on money that's sitting there. So suddenly we didn't have to go to our rich friends. We were actually able to get creative with the financing and deal structure. And what we ended up doing that I didn't even know was the term for it until later, and this is embarrassing, but this is just, again, the story, is essentially we ended up doing seller side financing. But that wasn't the plan going in. The plan going in was we make an offer, we give him cash, and it got tweaked by him, wanting to retain some equity that reduced the cash, and then saying, you know what, if I get paid over time, that's better. So we figured out a fair number, kind of like a healthy number, right? When you do loans, whether it's directly to a bank or directly to the seller in this case, you come up with a healthy number that you can quote unquote service, that you can afford to work with every month and still grow the business. We came up with that number. It was around what the revenue was at the time. That was like our monthly installment plan. And then we just got to work. So month 1, month 2, month 3, month 4. I think our revenue went 39 months straight, increased. Maybe there was like 1 or 2 months in there that would break even, or like we were plus minus $200, so break even. But otherwise, 39 straight months of growth. And for the first 20 or so, every penny went back into the business. So Justin and I didn't pay ourselves. I mentioned we ordered food delivery from Sprig. That was the only expense we put on the business that wasn't developers or designers. The only expense. Maybe 2 coffees. I think the day we launched, we spent like $50 at Mazzarino Cafe on Market Street in San Francisco. We sat there August 8th, 2016, August 9th on Product Hunt and bought a bunch of coffee. And that was it. So that's also why I had to keep that full-time job. Because we had this company doing 15K MR, then 20, then 21, then 22. Just really, I don't want to say a slog, like it was negative. It was really positive time, and I fond memories of that ramp up period. But it's easy to look at a company's MRR and think the founder must be rich. It's like, well, actually, the founder's making $0. But yeah, that was the process. And then again, like I said earlier, I think when you go through it, we're definitely not mid stage, right? Mid stage could be 10 million plus ARR, but when you go through the really early stage to like a stable revenue, whatever that number is for you, where you have predictable revenue and you have team members and processes in place, I think it's addicting. It is for me. And then you just want to do it again and again. And so then as we're growing, we're seeing a competitor pop up and we say, hey, we're interested in acquiring you guys. And they say, wow, okay, cool. Like they're familiar with us. They know that we're sort of like the bigger guy. So we bought them. We did it to another competitor. We bought them. And we found a niche content site that wrote content just for our audience. We bought them. And we just kept doing this. And then suddenly it was like, well, not only competitors are interesting, anybody who's got a B2B marketing Shopify app is interesting. So then we bought Cross-Sell. And then we started building Shopify apps. And then we sold the Shopify app. So it kind of became a thing. There was no master plan early on. But
Right.
After you do a few deals that have a hub and spoke commonality between them, in our case, that's B2B marketing apps, widgets, Shopify, e-commerce specific, those are the attributes. Once you zoom out and you look backwards at what ties together your portfolio as you build it, like we did, again, kind of on the fly, then you go, oh, okay, like this is actually my thing.
Mm-hmm.
So it was almost, I had to have an intervention with myself and realize, oh, I excel at B2B marketing SaaS products. I excel at that. I do well helping e-commerce stores with conversion rate. I do well at that. But if I had told myself that in 2016 or even 2017 or even early 2018, that that's like my career strategy or something, or that's my specialty as a marketer, I think it would have fallen apart or it would have felt limiting. But instead, what we did was we just tried a bunch of things. We bought other apps that aren't doing as well or they're not growing as fast. And guess what? Those apps are not B2B marketing widgets for e-commerce stores. So again, looking backwards, we were able to determine our shtick. And now when we slap that on our website, on Fork Equity, in our emails, our communications with potential partners and investors, it's restricted our deal flow to only look for a couple types of businesses. Suddenly everything started clicking. And once that happened, we realized we have to share what we've learned. And that's what led us to the course. And that's what led us here today.
Yep, absolutely. So you really moved pretty quickly in terms of you've made 10 plus acquisitions, I think you said. And if the first one was, second half of 2016, really in 3 years, to make 10 acquisitions, that's moving pretty quickly, I would say.
I guess so. I hope so. When it's a smaller company, you can kind of afford to screw up, I guess. So far, everything we've done has been fine. Like our worst performing product is called Cookie Assistant. It's a cookie consent plugin, and it's a great product. It was okay when we bought it. I think we've made it great. And that's no offense to the original founder. They have another really awesome product they're working on. So we bought a side project from someone. It's now ours. It makes some money, but it's never going to take off. There are dozens of cookie plugins. We've gained and lost ranking for organic, keywords. We're never going to try to advertise either for the cookie plugin, but we bought that in the wake of GDPR. So when we bought it, it was pretty hot. It was getting a lot of signups every day. Prior to, I think, end of May 2018 was when GDPR came into effect. So I don't regret it. The timing was right on. Again, it's a good product. We use it on the site itself. But that's just one example where we strayed from our niche and it hasn't worked out as well. But yeah, I think the main thing is we were able to move quickly because these were smaller deals. And then now an even bigger deal looks like a small deal because we've learned a lot and we have more resources at our disposal.
And are you typically following the same type of structure if you can in making an acquisition? Are you using, seller side financing, using, other tools, whatever you can use to not have as much cash up front?
I tried to be structurally agnostic, actually. We've now done some all cash. We've done a mix of debt equity holdback. We've done performance. Yeah, we've kind of done all of it.
Okay.
I guess it's probably okay to have a preferred structure, but if you do have a preferred structure, you should know why you prefer it. So, for example, we know a fund that prefers cash, and that's for two reasons. A, they raised the fund, so they need to deploy the cash, or they'll get angry investors asking essentially for interest because their money's sitting in the account. And B, they prefer to pay cash because they've witnessed firsthand the buying power of paying cash up front. They understand that a founder who wants $1 million for a business is maybe okay to take 800,000 when they say we can pay you next Friday.
Right.
And so that's an age old strategy, right? That just sticks to things that don't change about the human psyche of wanting short term gains and wanting instant gratification. So they've found a niche there with using cash in that way. What we've found is, people that are selling businesses to us, they're often their side projects. And if it's your side project, it means it's not your primary source of income, which means you don't need really the income coming from it, which means you don't need to take a haircut on the valuation because you're already doing fine with your income from your other projects. So we've not found cash to be some huge motivator. People seem to be more interested in maximizing valuation. And when you do that, that lends itself well to paying over time. So
Right.
I think each deal structure has kind of an angle by which it becomes the most valuable to the seller and the buyer. It just depends on what kind of businesses you're buying.
That makes perfect sense. So I do want to take a step back, I guess, and give people a sense of how well your business is doing overall, if you can. Whatever you're willing to share. I know that Notify or Fomo was your first acquisition, and you shared some numbers there. Either share, how well that business is doing, or if you're willing to share sort of overall portfolio numbers. I'm sure people are curious to hear about that.
Sure. All of the above is cool. So some highlights. FOMO's best month at the peak of our, what did I mention? Like 39 month
Growth.
rise
Yeah.
was $154,000.
Wow.
That was not all MRR though, or I should say that wasn't all recurring revenue. Our best month with recurring revenue was around 112,000. That was earlier this year. And now
That's
we've been
awesome.
hovering around 100,000 MRR. So that's FOMO. Our next best win in the portfolio is cross-sell. Cross-sell is just about to hit 30,000 MRR. And we see a long future actually for cross-sell, almost exclusively in the revenue department versus product. Whereas FOMO, I could see it going both ways. There's a lot of product to build, a lot of revenue opportunities. With cross-sell, we've made the product so much better since acquiring it, but we've been held back by these legacy users paying $7 or $8 a month. So what we just began doing at cross-sell is like an upgrade campaign, which if you're building a business on Stripe, this is incredibly easy to do. You send users a couple emails letting them know that your pricing is changing, and you write a migration script that bumps everyone up after some reasonable amount of time. And then you refund people who claim to have never gotten the emails. But with a Shopify app, you cannot do that. People have to go back through the OAuth payment consent flow, which is a lot of friction. And even if someone's happy to upgrade, for example, the marketer who uses your tool, they can't do it. So on Shopify, only the owner login can accept billing charges, even if their invited users are admin status. So there's a couple quirks there where Shopify kind of treats you like children, and I'm not happy about that, because you'll buy a Shopify app that's got, in the case of cross-sell, it had a couple thousand users that signed up in 2015 who were paying $7, $8 a month. And you look at that and you go, wow, well, if we can increase the value of this product, we can double the price and essentially double the MRR. Obviously, there's going to be some cannibalization and churn. But in other words, that's a big opportunity staring you in the face. Well, it doesn't work that easily with Shopify apps. So we did actually a small batch test in the last 3 weeks or so. We put together a cohort of users who are logging into the app all the time, yet they're on a plan that was 3 years old. So this is like the most likely people to upgrade. They use the tool very heavily. They're power users. They're paying $8. They've witnessed us increase the value of the product tremendously since we bought it in 2017. So we've been hacking on it for 2 years. And we decided to put them through a campaign, about 100 stores, and tell them, hey, we just need to upgrade you to continue investing in the product. You've seen what we've done with the last couple of years. Click here, click here. And in the last few weeks, 45 of those 105 stores have upgraded from
Wow.
$7 or $8 a month to $20 a month. So that's like 40 times 13, so around 560 net new MRR. I
Mm-hmm.
think we've had no cancellations yet, but we'll find out very soon. So in a couple weeks is our deadline, and anyone who hasn't upgraded, we're just going to nuke them. And it's sad, it's tempting to do the wrong thing. Obviously, it's easier to do the wrong thing, which is to be happy with the people who upgraded, and anyone who didn't upgrade, just silently remove the paywall and let them stay. But we're not
Mm-hmm.
going to do it, because then that's not fair to the people who did upgrade. So
Right.
yeah, we're kind of just cleaning house now. And
Hmm.
even if the MRR stays about the same, I'm glad that we're increasing the ARPU, because that allows us to justify higher quality support. We have fewer customers that pay us more. That's fine with me. So MRR at cross-sell is nearing 30K. And depending on if we continue this upgrade campaign to another, let's say 1,200 legacy stores, we think we can get to 40K very quickly. Other apps like Labaloo is a floral invoicing tool. We're still very early days there. We bought it at like 1,500 MRR. Now it's like 3,300 MRR. So we've 2x that, but we have a lot in mind for that product. So I've just begun involving the Fomo team members actually on Labaloo, whereas the last year and a half it's just been myself. And then overall the portfolio, to combine the other small apps or competitors that we've acquired, essentially our portfolio is doing around 1.5 million ARR. And this is all starting from a seed of zero
Yeah.
in years. So, going through this process is the one statement I've achieved from it is, you can do anything or anything is possible, or if I can do it, you can do it. So I was just broke in San Francisco, spending all my money on rent in 2015, 2016. And now we've got this really stable portfolio that's leading to incredible opportunities. And I don't think I'm ever going to do anything else. So I think Fork Equity, if it's up to me, right, and it is, will be around for
Yeah.
several years, because it's just a vehicle by which we can do anything. We can launch side projects. We can run experiments. We just open sourced Fomo's entire design system at orangecss.com, so anyone can design apps that look as pretty as ours.
Nice.
And there's just, it's like a lab. So that's what I've been trying to tell the team is, this is a lab, and we have the microscopes and the beakers. So if you want to run an experiment, it's all right here for you.
First of all, congrats.
Thank you.
That's a lot of success in 3 years of acquiring, starting from zero, like you said. 1.5 million in annual ARR is amazing. And so I'm sure a lot of people listening are wondering, you've got all these apps, you've mentioned team members, and maybe you can talk about the size of your team and what they're doing a little bit, but how do you find the time to effectively run all of these projects at once? There's a lot of moving pieces, a lot going on.
Well, I won't water it down, and I don't say this to try to the cool word kids say these days is flex, but I do work really hard. And I work a lot. So, I work on the weekends. I've worked every weekend for the past 2.5 years. And I don't talk about that too much. I might joke about it half-heartedly on Twitter. But to me, what I've found is that's what it takes. Other people say that's ludicrous, that's ridiculous. They might have kids, they might have other things going on. I don't have kids, so that's important context. But I also think it's important to realize that when I say something like, hey, here's what I'm working on, oh, and by the way, I don't have kids, I think it's the losers who hear that and say, well, no wonder, well, I do have kids. Because it's kind of like, well, if you have kids, maybe you're a few years older than me. What were you doing when you were my age and you didn't have kids? So the context matters, nuance matters. But the point in all of this is I work really hard, and it's only been over the last few months, quite literally, that I've realized this is not a good strategy. So in the past few months, a few changes we've made. First of all, we've kind of structured our support, how we handle support, because what I've found with software is that support is this can become a monster. You could spend all of your time on tickets all day and live chats and not build a single feature, not think at all about increasing revenue, innovation, product. You could spend all of your time on support. And so these side projects, like the ones we're trying to buy, I think often are stuck for that reason. So the founder wants to build something. They have like some vision in their head and it's bothering them. They have to get it out in the world. So they build it. It becomes mildly successful or even more than mildly successful. And now they're spending all their time just supporting it, fixing bugs and doing tickets. And they can't get to the next level innovation wise because to do so would require being negligent or, ignoring their customers. And so then they're stuck in this position. And this is why actually why our fund is called Fork Equity. It's for founders that are in fork in the road. And the way we define that fork is, let's say you're doing 10K MRR and you're a solo founder. Well, by all standards, by all measurements, you're literally killing it, right? You're in the 1% earners on the planet. I think if you make 10 grand a month and maybe you have $100 or $200 worth of SaaS apps and hosting fees, you are murdering it. You can be location independent. You could pretty much work whenever you want, but you're going to be working hard. And if you want to, let's say, 2x your product from 10K to 20, you need help, most likely. You either need to hire another developer or a marketer or fix your design, or you need to hire someone for support. And what we've observed is that when founders get to that stage, they don't really always want to take that risk. They started this thing. It's printing money. Why ruin a good thing? They could hire someone and reduce their personal income, let's say, to 3K a month. Okay, now they're like the digital nomad level bracket.
Right.
And then they have to just make this bet that $7,000 a month investment over some period of time will pay off. But even if it does, let's say I'm making 10 grand a month and then I pay someone 7 grand a month to take over X, Y, and Z. And maybe it's not someone, maybe it's someone's. I hire a support person for 3 grand. I hire a developer for 4 grand part-time. Well, now I'm down to 3K and I'm sitting and waiting till we hit 17K. Once we hit 17K, now I'm just broke even. I'm now personally back at making 10K. So I have to double my business from 10 to 20 to increase my revenue, my personal income by 3. And what we found is a lot of founders, they get to that point, that inflection point, they go, yeah, I'm just not going to do that. Like that's again, another hedonic treadmill. It doesn't make sense. Now, it is fun to create jobs, but not everyone thinks that's as fun as I do. So you get to 10K, you're just going to sit on that. Why ruin a good thing? So those are the types of businesses we're trying to buy, where the economics to scale it don't make sense for the founder. It makes more sense for them to either have an exit or to just stay intentionally small. So how, kind of to answer your question, how we've been doing this is the first thing we did a few months ago, actually, a couple months ago now, we migrated all of the Fomo team members to work for Fork. So now, like, legally, they work for Fork. And Fork, you could think of as like an agency, and our portfolio companies are like clients to that agency. So we made a very simple spreadsheet. This is just a quick logistics tip, but I think it illustrates what's going on. We made a simple spreadsheet with all the portfolio projects, and we have a weekly meeting. And before the weekly meeting, you plug into the spreadsheet, that in the last 7 rolling days, since the last meeting, I spent 20% of time on Labaloo, 40% on Fomo, 10% on cross-sell, something like that. And it all adds up to 100. And then at the end of the month, we true up those expenses among our companies. So if someone's salary is, let's say, 5K a month at Fomo, or their salary is 5K a month and they spend 50% of their time on Fomo, then, Fomo will pay Fork $2,500. And then Fork pays everyone from a centralized bank account. So that's what we've started doing a few months ago. I think it's really interesting. It's kind of allowed us to make our profitable companies even more profitable, like Fomo. And then it's allowed us to invest otherwise retained earnings that would be taxed very highly at Fork. We now are investing those into new studio projects and like startup ventures, essentially. So that structurally, that's part of it. The other part of it is just more process and documentation. So of course, we have knowledge bases and blogs and helpful resources at each of the projects we're working on. But we also created internal documentation, like insane internal documentation. So using a GitHub wiki, for example, is one thing. And we have that. So we have how to set up Fomo on your machine. But that's not that interesting because there's like the same 5 engineers have been working on Fomo for a few years. Where it's gotten interesting is we created something called the Fomo Bible, which is actually an instance of developer documentation. So we use a tool called readme.io for our API docs. We just spun up a second account for README, and now it's internal, so only we can log into it. And it has like 100+ articles on everything from like customer was paying through Shopify but wants to upgrade to annual and wants their annual plan to be on PayPal. How do they do that? So we have documentation internally to do that, right? And so it's gotten not out of hand, it's very in hand now because we no longer have to have a local expert on the team who just sort of intuitively knows the history of our product and can do 80 different operations that aren't specified. Instead, now every time we see something in intercom or support ticket that hasn't been turned into an admin panel button or toggle or whatever script, we now are turning those into to patches in the app itself, so that with this vision that like one day a monkey could run Fomo support. So we'll never get there, right? But if you work towards that goal, you'd be surprised at how much you can, systematize. So process systems, making the team lean and work cross-functional across other projects. Those are the high-level ways we've been able to, I think, pull this off and scale. And then on the more micro individual level, I do work a lot. My wife is also my business partner.
Okay.
And then another aspect of that is that we do everything. And I don't mean that to say that we take credit from any of our colleagues. What I mean is that we do marketing, we do sales, we do biz dev, we do development. So on a day-to-day basis, myself and my wife, we will write code, we'll fix bugs, we'll build features, we'll write blog posts, we'll manage people. So by being able to touch each part of the business that needs help at any given moment, that also is very empowering. Whereas if you have one specialty, if you know SEO and you go into buying niche content sites, that's fantastic. But you are going to need to know like 20 other things to run a niche content site. It's just sort of like the unfortunate reality. And that's the same in software. You could be great at marketing, but then you do need to know how to run a sales call, because some of the leads you market to are going to be like a huge company that's not just going to self-service sign up on your buy now page. They're going to want a phone call. Then they're going to want another phone call. Then they're going to want a legal contract, some SLA that guarantees service. Well, now you need to know how to work with lawyers. And then they're going to want to understand your IP address so they can whitelist you behind their firewall. Well, now you need to know a little bit about DevOps. So this all started because you were a marketer who was able to build demand gen for this big company. Well, now fast forward a couple months, you've had to touch every piece of the business to get the deal done. So that's what those are just our learnings for now.
Yeah.
And over the next couple of years, we hope to I said this to the team in our last retreat, I want to make these companies boring. And I mean boring in the operational sense, not boring as a customer.
Right.
As a customer, they see, I think, a lot of interesting things going on. We're running experiments all the time. We're figuring out which of our competitors are dishonest and writing about it and naming names. I mean, we're trying to do some really crazy stuff. We have customers email us that are upset because we have curse words in our email newsletters. So we're keeping things, I think, very interesting, at least interesting for us and some of the more adaptable customers. But internally, the company should be boring. Like if someone wants a refund, that should be a really boring 1-2 click to make it happen.
Right.
If someone, thinks something is broken, there should be a really boring process to like check the error logs and immediately see what's broken and why. And so that's what I've been pushing us towards lately, because the more boring things are internally, the less mental overhead running these businesses will require, which means the more businesses we can work on.
Absolutely. Thank you for sharing all that. I mean, we could spend a whole hour sort of diving into, what you shared in terms of standard operating procedures and the tools you're using and management style and a lot. But I have a few other questions I want to get to. But just to wrap up that in terms of team, so roughly how many employees does Fork Equity have overall that you're using, across the portfolio?
Full-time and part-time, about 10 right now. And full-time, maybe 7. And everyone now, all the full-time team members are engineers. So that's probably like the final nail in the coffin there to wrap up the previous question is we've been able to scale by just having everyone be able to do everything. And, of course you could say engineers, well, they're not marketers, so how are they really doing everything? Well, we invented something called growth engineering missions, where every few months I give the engineers literally a marketing campaign. and they have to do it. But it's not like, hey, you write code, now go send cold email. It's never that. It's always an engineering project that just directly impacts our top line, middle of funnel, churn, and so on. So now we've been able to, I think, be more resourceful, because when I had just marketers on the team, now there's like this extra job that pops up, which is just managing and liaising between a marketer and developer so that they can get work done together. And it just, after 5 tries, I hired 5 full-time marketers since 2016. After 5 tries, I decided, you know what, let's just be an engineering organization, but make engineers responsible for some parts of growth.
Yeah. Are these US based engineers, overseas, a mix of both?
Everywhere. So in the last year, a couple of our US based engineers have left the team for one reason or another. But even one of them, who I met in New York, he was living in Japan. One of them was in San Francisco. Our VP of engineering lives in Calgary, Canada. Our other engineers now live in Europe. They were in Berlin and Slovenia. Now they're all Slovenia. So yeah, everyone's been kind of moving around.
Okay.
Support is in US, in Asia, in South America. So yeah, everyone's been moving around. And to handle that, besides having weekly meetings, we've been doing retreats. So I think we've done like 4 team retreats. We've gone to Vietnam. We've gone to surf camp in Portugal. We've rented a yacht and participated in the Barcelona 50 race in Italy, and we've gone to conferences all over. So we try to get a lot of face time, at least a couple times a year, with one another.
Awesome.
And then the guys who are local to themselves occasionally will rent like a room and jam or have a hackathon for a day or two somewhere.
Awesome. Very cool. So I know we don't have a ton of time, but I really want to dive into, and I think people probably want to hear, is like, how did you grow some of these so much? What are the growth levers that you've sort of pulled? And specifically for FOMO, I think is, maybe the largest growth story you can talk about. But what are the levers that you're typically looking at? And if you want to talk specifically about FOMO, you can share, what you did there. Or if you want to talk more generally, what are things that you look for to grow an acquisition?
So Fork Equity finally has, I think, a pretty strict set of criterion for growth levers. And we try to kind of reverse engineer the deal flow process by what channels we think would work for a company. And it's not really what we think in terms of like, let's guess. It's what we observe when you talk to a founder and you say, well, how are you growing? And if they say XYZ, we might be interested. And if they said ABC, we're not interested. So for example, the way we got there was by identifying which growth channels we really don't want to be competent at. For me, I'm not interested in being great at advertising, for example. Advertising is another hedonic treadmill. If you do really great ads, it means that eventually those really great ads won't perform really well anymore, and you'll have to reinvent the wheel and make new really great ads.
Mm-hmm.
And that's just inside the bubble of you and the audience you're attracting. You have to outdo yourself. You have to hit the personal best, every in period. When you then factor in that marketers love to share what they're doing, so when you do really good ads, other marketers learn how you're doing really good ads, and then they do really good ads, and then the cost per click goes up, or whatever metric you want to talk about. Suddenly ads is just this in theory infinitely scalable channel, but it's not really, because your creativity and temperament won't scale, and your customer lifetime value is probably also not going to increase at the pace by which Facebook's advertisers looking to attract the same audience is going to increase.
Right.
So if a business wants to increase their ads, I'm not interested. If the business increases significantly or predictably through SEO, I'm maybe interested, because even SEO, like a Google impact can penalize you or hurt you. It's sort of like Russian roulette. And then if a business rather wants to grow through word of mouth, because there's some sort of like, I don't want to say viral loop, like buzzword viral, but just a literal mechanical viral coefficient where you can predict that every 50 signups will refer 3 new signups, or whatever your coefficient is. Those are very interesting to us. So with FOMO, for example, it's a very visible product. We're showing hundreds of millions of notifications a month. None of those are branded, by the way. We think that's like an evil thing to do. If someone pays for our tool, we're not going to brand it. Like if we had a free plan, maybe we'd brand it, but we don't.
Right.
So we don't. But just do the math, right? Hundreds of millions of notifications a month. If 1% of 1% of 1% of those people seeing it are marketers who think this is kind of interesting, the same way I thought it was interesting when I discovered Notify in 2016, they're going to look it up and very easily figure out who we are. So that's been actually a primary growth driver for Fomo. So for example, we don't actually need more customers to get customers per se. We need more websites to go live. And when we realize that, you kind of get this sense that like, oh, one customer could put Fomo on one website, but they might actually have like a personal blog and a side project and their wife's Etsy store. And when we realized that, we eliminated the billing based on websites, and now it's just based on notifications. So now we encourage every user, like, add all of your websites. There's unlimited websites.
Gotcha.
On every plan. So that's how FOMO grows. Some of these other companies, like Labaloo, it ranks highly on Google, but I wouldn't say we depend on that. I'd say we depend on just being really good to our customers, and then they give back. So I really have adapted, I think Ben Chestnut, CEO, founder of MailChimp's strategy. I think he created this years ago. He blogged about it anyway on Tiny Letter years ago. And since then, people have built entire marketing agencies by this name, but it's the flip the funnel concept. That instead of trying to attract a bunch of leads at the top and then at the bottom some customers squeeze out, just flip it upside down, be really, really good to your customers. And that funnel you can visualize flipping into a bullhorn. Your customers then tell other people for you. So not every business works this way. And I've written about this. If you Google like Ryan Kulp, anatomy of a referral, you'll see what I think about that. But not every business is going to be shared. If a business, for example, gives you a big competitive edge, you're going to keep it a secret, no matter how great it is for you. But if a business, if using a product or service and then talking about it actually increases your status in some way, you will share it. So an example of that is our course. People are sharing our course, microacquisitions.com, left and right, because to communicate to your friends and colleagues that you're now getting into building a portfolio, you're actually kind of subliminally communicating that you are in a good place financially and that you are now thinking above and beyond your day job, your current present income. You're now thinking about your future. So it looks like, you're showing that you're not just an instant gratification type of person, and you're setting yourself up for long-term success. So people are sharing this course like crazy. But I've built other courses like cold email course that has hundreds of students. I built how to validate an idea, free email course, has 12,000 students. I have a $2,000 marketing course. Those don't get shared at all. They don't get shared because no one wants to say, hey guys, I just bought this, cold email course so I can finally learn how to do cold email. And guess what? I'm a full-time salesperson. So, well, that doesn't look good. You'll simultaneously get value from it, but you'll actually lose social capital if you talk about it.
Right.
So these are like some insights we've had. And now when we're looking at businesses, I almost want to know how they grow more so than any of the other challenges. Like if it's a code problem, no problem, right? We have great engineers. We can rebuild apps from scratch, like very, very quickly if we hate the source code. If it's a people problem, that's irrelevant too, because we've always let everyone go when we buy a company, and they know that ahead of time. So we're not going to keep the original team. We want fresh blood. But if it's like a growth problem, if they're depending on like a dialed in Google and a Google account or a Facebook account, we're totally not interested. But when the growth channels are A, B, or C, we already know kind of what we can do with that.
Yeah, no, that's great tips. And also kind of explains what you're looking at to acquire a deal. What are sort of the either metrics or ideas that you might have post-acquisition, can help you sift through the ideas that, or the deals that might come your way.
That's exactly right.
Yeah. So again, I could ask a ton of questions. We could probably chat for another hour, but I'm going to give you just sort of one last question here to share whatever I missed that I didn't ask you about that maybe you thought was worth sharing, or what other tips do you have for somebody that's looking to make their first acquisition?
Well, at the risk of pointing people down the wrong path, so take what I'm saying with salt, I think you have to just start. And I didn't even have this thought. This isn't an original thought. Just start. Just start. Like if someone wants to lose weight, that's one thing. Just start. If someone wants to learn to code, that's one thing. These are tiny investments. You can spend 20 minutes on Codecademy. There's no risk to you. The concept of just start when it comes to buying a company seems like really bad advice, but the reason I say it is because I actually just did a guest lecture with someone on microacquisitions.com. He's a student alumni. His name's Deepak. And within 60 days of taking the course, he bought 2 products and almost bought a third. The deal fell through. So he's now using the team members from the first 2 to build a competitor to the third. So he was reaching out to me just ecstatic that he's changed like his whole strategy for building wealth is now like building a portfolio. Even though he has a very successful company already, he decided to give it a try. And what he says in his guest lecture is like, the only way to really do this is to do this. And if you need to start really small, like buy a WordPress site with 50 blog posts that gets 3,000 page views a month and it makes $8 a month on AdSense, just start. So what he communicated is that the lessons you're going to learn, whether you're running a business that makes $8 a month or 80 or 800 or 8,000, are kind of similar. And we've learned that too. It's like, it takes almost the same amount of effort to run a company at 5K MRR than at 50. If you structure it right, if you structure it right. That's why you can see companies with vastly different average revenue per employee. That's why Google is like leading the pack at like over $1 million, I think, average revenue per employee. Some companies have 50 times the number of employees and 1/1,000,000th of the revenue. That's because it takes like the same amount of net effort. It's just whether you put that effort into systems or into grunt people. So I think you have to just start, but start really, really small. You can go on 1kprojects.com. Bev, who runs that site, she's also a student and alumni. She's part of our alumni community. She's been super supportive, and so we support her. I've bought and sold projects, side projects on 1K projects. You can buy stuff for $300, and $300 from now, you're going to have sort of the equivalent of an MBA education because you're going to manage a website, you're going to build a brand, you're going to have social media accounts, you're going to have Google Analytics data you can look in to see where traffic's coming from and what kind of traffic converts higher. You're just going to learn so much, and the only way to do it is to do it. So my recommendation to everyone is to just start. If you're looking for like more direction on how to get started, whether it's how to structure these financing deals, how to form an entity to do this legally, how to think about increasing pricing for something that you just bought, that's kind of why we built our course at microacquisitions.com. But I'm not here primarily to pitch that. I just want to help more people forge a career the way I have. I did it very serendipitously, but now I think it can be done more intentionally in acquisitions instead of just trying to get that next raise.
Right. I love it. Great tips. I definitely wholeheartedly agree with your advice to just start. I mean, I was just, as you were talking, I was thinking back to even just buying my first domain name. I think I thought about buying a domain for a year before I actually did, right? And it's like a $15 investment, right? It's just sometimes we limit ourselves. We're like, I can't do that. But once you buy the domain, or I remember setting up my first, WordPress, installing WordPress for the first time, didn't cost me anything, but just getting some words on the website and, writing my first blog post, again, just putting in a little bit of effort, it gets that snowball rolling. And, for me, of course, it's been years and that snowball is built and is doing well. But if I never, just bought that domain or started that first site, and now, of course, I've made some acquisitions as well. So 100% agree with that for people listening, that they just start, figure out what that level of risk, what level of investment that you're able to put in, and dive in, and you can learn the ropes pretty quick, like you said, with a very small investment to start, and then you can scale from there.
That's exactly right.
So thank you, Ryan, once again for hopping on the Niche Pursuits podcast. It's been an absolute pleasure. And if people want to follow along with you, they can go to microacquisitions.com and, of course, forkequity.com as well. And then they can view your individual apps that you've made if they want to research you even more.
Yes, stalking is always welcome, and I'll stalk you back. So yeah, also
Awesome.
Feel free to ping me on Twitter at Ryan C. Kulp. Thanks for having me.
Perfect. Thanks a lot, Ryan. Thank you once again for listening to the Niche Pursuits podcast. As a reminder, this episode has been sponsored by Ezoic. Ezoic is a Google award-winning technology that everyone from niche website owners to major brands use to grow and monetize their websites. Ezoic is a Google certified publishing partner. It's a platform that leverages artificial intelligence to help you optimize revenue and monetization on a per visitor basis, and so much more. If you want to check out Ezoic, go to nichepursuits.com/Ezoic. Again, that's nichepursuits.com/Ezoic. Thanks a lot.